Jake buys a rental property. Marcus puts the exact same money into index funds. Both are convinced they made the smarter choice. They are both wrong. They're wrong because they miscalculate how they actually pay for these assets. One completely forgets to count the hours, and the other forgets to count the psychological toll. To see what reality looks like, we have to run the actual numbers on these two exact paths over a full 20-year period. Building wealth is a lifestyle decision about exactly how you want to pay for your returns. Jake and Marcus start identical. $50,000 saved, $55,000 salaries, same age. Jake uses his money as a down payment on a $250,000 rental property, securing a mortgage. Marcus drops his into an index fund, adds $300 monthly, and walks away. On day one, Jake has a physical house, a tenant, and a story for his friends. Marcus just has a brokerage login and a confirmation email. On paper, Jake feels brilliant. He collects $1,800 a month in rent, pays a $1,330 mortgage, and clears $470 in profit before spending a single dime on anything else. Real estate wins the dinner party test immediately because a house feels tangible. But on-paper profit does not equal spendable wealth. Jake is using the bank's money. Deploying $50,000, he controls a $250,000 asset and captures all of the property's geographic appreciation. But he also took on $200,000 in debt and concentrated his investment in a single neighborhood. If that zip code declines, he absorbs the losses. Jake's $16,000 gross cash flow is deceptive. Taxes pull $3,000, insurance $1,500. He replaces a water heater for $1,200, fixes a roof for $2,800, and budgets maintenance. A vacant month shrinks his net cash flow to a couple $1,000s, and that ignores the hours spent managing the property to save money, taking phone calls at 10 p.m., coordinating plumbers on his lunch break, and running weekend showings. For the first decade, Jake isn't enjoying passive income. He purchased a highly stressful, part-time job to keep his asset alive. Marcus, meanwhile, spent 0 hours managing his portfolio. 0 weekend showings, 0 emergency plumbing calls. This graph maps out compounding. By ignoring his account, Marcus's money grows at a 10% average return. The gains start generating their own gains, accelerating his wealth effortlessly. But achieving that 10% average requires surviving violent market volatility. Watching $150,000 life savings plummet to $95,000 in a matter of weeks is gut-wrenching. Because it takes exactly 5 seconds to liquidate a stock portfolio, average investors panic. They hit sell during a crash, locking in catastrophic losses at the exact worst time. You cannot panic sell a 3-bedroom house on a Tuesday afternoon. That illiquidity protects landlords from their own emotions. Index funds also don't send you a monthly rent check you can use to replace your day job income. Index funds offer total freedom of time, but you pay for your wealth with your nerves. By year 10, Jake's property has appreciated, and his loan balance is down. But subtracting the $30,000+ spent out of pocket on taxes, insurance, and repairs, his total equity sits around $175,000. Marcus has his $50,000 principal, $36,000 in monthly contributions, and pure compound growth. This chart reveals where they stand after a full decade. Their total wealth is completely tied, both hovering right around $170,000 to $180,000. Jake holds his wealth in a single asset in one zip code, heavily leveraged with debt. Marcus is fully liquid and diversified across thousands of global companies. The final numbers are identical, but Jake spent hundreds of hours working for his wealth, while Marcus simply waited for his. Fast forward to year 20. Jake's property is nearly paid off, but he spent 2 decades dealing with tenant turnover, property taxes, and at least one massive, expensive renovation. Marcus's portfolio has reached the explosive phase of compounding. His original inputs are now completely dwarfed by massive passive market gains. Over a 20-year timeline, both paths end in a near tie, converging around $450,000. But if Marcus increases his contribution by just $200 a month, his total skyrockets to roughly $600,000. To significantly increase returns in real estate, Jake has to hunt for another property, take out a second mortgage, and completely double his manual workload. Real estate eventually hits a hard ceiling based on your personal energy. Index funds scale infinitely with 0 extra effort. This scorecard shows when real estate makes sense. If rent covers the purchase price, you want a house hack, or you need tax shelters. Real estate wins. If you're willing to trade weekends to run a business. But if your goal is absolute passivity, the stock market wins. Choose index funds if you want your wealth to scale in the background without a second job, provided you have the discipline to not panic sell when the news gets scary. Ignore anyone who says one asset is universally better. The real choice is picking the path that matches the currency you are willing to spend. You either pay with your time or you pay with your emotions.